Merci Carole et merci à tous et bienvenue à cet appel organisé par le PSIF. Je suis Peter Routledge, Superintendent des Institutions Financières. Before I go any further, I'd like to acknowledge that I am speaking from the traditional unceded territory of the Anishnaabeg Nation. I'm grateful to have the opportunity to be present in this territory. I recognize that those joining us today may work in different traditional Indigenous territory. Recognition of our shared history is a crucial prerequisite for building trust and reconciliation with our compatriots of Indigenous descent. I urge you to read the final report of the Truth and Reconciliation Commission of Canada. In my first speech as superintendent last month, I argued that I assumed the responsibilities of superintendent at a particularly consequential time. It's true that OSFI has a pretty good track record of prudent financial regulation. And Canada's financial system has fared extraordinarily well through several bouts of financial system volatility. But as always, we continue to find ourselves facing great uncertainties. For example, the continuing adaptation to the urgent necessity of reducing greenhouse gas emissions and the digitalization of financial services. These are extraordinary long-term risks that will require short-term responses. But I would first like to shift our gaze to both the immediate past and the near future. When COVID-19 was officially recognized as a global pandemic, we at OSFI took a number of important actions in March and April of 2020 to preserve financial stability. We implemented a range of regulatory measures in response, some of which were: we suspended regulatory consultations and initiatives to allow federally regulated financial institutions and pension plans, FERFIs and FRPPs respectively, to concentrate their efforts and resources on adapting to the pandemic. We temporarily changed our treatment of payment deferrals for mortgages, small business loans, and household loans, so FERFIs would not have to set aside higher capital for loans in which they had permitted deferrals. We clarified how exposures to loans offered through Government of Canada support programs would be treated for capital and leverage purposes. We provided temporary exclusions to leverage ratio requirements, enabling banks to support lending while the country fought the COVID-19 virus. We adjusted market risk capital requirements for banks so that the severe capital market volatility of spring 2020 did not constrain lending. We introduced transitional arrangements for expected credit loss provisioning through the end of 2022 to allow a portion of allowances that would otherwise be included in Tier 2 capital to instead be included in higher quality common equity Tier 1 capital. We temporarily increased the covered bond limit to facilitate greater access to Bank of Canada funding facilities. We smoothed interest rate risk requirements for participating businesses to remove unwarranted volatility in life insurer capital requirements. And we suspended semi-annual progress reporting to OSFI on International Finance Reporting Standard 17, or IFRS 17, which sets out the accounting for insurance contracts. This list, however, although long, leaves out our most important accommodation. In this case, for Canada's systemically important banks, the release of the Domestic Stability Buffer, or DSB. But before I go further in this speech, I'd like to set the context for this accommodation. Several years prior to the pandemic, when the Canadian economy was healthy and growing, OSFI created the Domestic Stability Buffer to act as a counter-cyclical buffer. So what is the Domestic Stability Buffer, or DSB, exactly? Simply put, in good times, we require Canada's 6 largest banks, known as Domestic Systemically Important Banks, or DSIBs, to hold an additional buffer of capital, more than our other guidelines and rules require. We do this just in case hard times unexpectedly arise, so that banks have a buffer that can absorb the impact of those events. We know that when, not if, such hard times arrive, banks might otherwise restrict lending in order to preserve capital and thereby meet our requirements. Should all banks take this same action at the same time, it could then quickly exacerbate a financial or economic shock via a widespread drop in lending and consequently in economic activity. Exactly what we don't want to happen during stress times. We want banks, more precisely our DSIBs, to continue to serve their intermediation role and extend credit into the economy during downturns. And so the domestic stability buffer gives OSFI a tool to lower DSIB's capital requirements during the worst periods of a recession. This is a safe and responsible action to take because the domestic stability buffer would have already required banks to hold more capital than needed during good times. At the beginning of March of 2020, the DSB was set at 2.25% of risk-weighted assets. In addition to the rest of what we call the capital stack, systemically important banks had to have common equity tier 1 capital of at least 10.25% of their risk-weighted assets. On March 13, 2020, when COVID-19 struck in earnest, OSFI decided to lower the DSB to 1% of risk-weighted assets, a release of 1.25%. This release provided Canada's 6 systemically important banks with ample loss-absorbing capacity, while at the same time freeing up about $300 billion in lending capacity. This DSB release supported ongoing lending through the pandemic, and banks did not breach their capital requirements exactly as intended. At the same time as the DSB release, and in the face of the prevailing uncertainty associated with the pandemic, OSFI took the prudent step of communicating our expectation that all FERFIs would halt increases to regular dividends and executive compensation, as well as pause common share repurchases. Canada's FERFIs met this expectation, an encouraging indicator of the responsibility of their boards of directors and senior management. Today, Canada continues to make progress in combating the COVID-19 virus. The financial and economic risks posed by the pandemic have abated somewhat, while FERFI's capital levels have remained high or have even grown. Accordingly, OSFI has gradually removed most of the supervisory regulatory accommodations put in place in the early days that followed the pandemic's onset. In June of 2021, we announced an increase in the domestic stability buffer. In fact, on October 31, 2021, last week, the DSB for Canada's 6 systemically important banks increased to 2.5% of risk-weighted assets, which is above the pre-pandemic level of 2.25%. To date, however, we have maintained our expectation around capital distributions, reflecting our prudential focus. For several months, we have faced the question as to when OSFI should lift our capital distribution expectations, particularly as many financial risks triggered by the pandemic have receded. I believe now is the time for OSFI to lift this expectation, and given the high degree of public interest in the question, I think it appropriate to explain our reasoning for this decision. 3 key arguments underline our decision. First, the original rationale for the capital distribution expectations is no longer valid. Second, the appropriate responsibility for capital distribution decisions rests with the boards of directors and senior management of FERFIs. And third, we have confidence that FERFI boards of directors and senior management will act responsibly in making those decisions. Let me give you more context on our first rationale, or first reason supporting this decision on capital distributions. The original rationale for the capital distribution expectations is no longer valid. You'll recall we announced our capital distribution expectations as an appropriate counterbalance to all the regulatory accommodations we put in place to support Canada's FERFIs through the pandemic. At this point in 2021, we have removed most of these accommodations. Canada's FERFIs have weathered the shocks of the pandemic quite well in 2020 and 2021. As such, we do not believe that lifting these expectations, which were always intended to be temporary, will detract from financial institutions' ability to support the economic recovery or from public confidence in the Canadian financial system. Now to our second argument. The appropriate responsibility for capital distribution decisions rests with the boards of directors and senior management of FERFIs. Boards of directors and senior management of Canada's FERFIs have a special responsibility when making decisions about their institution's capital. They must give due regard to all stakeholders, including depositors, policyholders, and other creditors, as provided for by our mandate, but also customers, employees, shareholders, as well as society at large. Given the performance of Canada's FERFIs through an array of economic crises, I believe it is right to conclude that, in the main, their boards of directors and management have developed a habit of making responsible decisions, perhaps encouraged towards this habit by their financial services regulator. In fact, the OSFI Act, our governing statute, created and amended by democratically elected parliaments in service to Canadians, instructs my office to allow FERFIs to compete effectively and take reasonable risks. What's more, it stipulates that boards of directors are responsible for that competitive risk-taking. Decisions on capital distributions are a key part of that competitive risk-taking. How much of earnings to distribute to employees as incentive pay, how much to return to shareholders in the form of dividends or common share repurchases, and how much to retain for investment. These decisions rest in the dominion of FERFI boards of directors. OSFI's role is to supervise FERFIs and determine whether they remain in sound financial condition in the wake of these decisions. When a capital distribution fails to meet our definition of sound financial condition, we act urgently but quietly to maintain public confidence in the system and to correct unacceptable digressions from sound financial practices. This describes normal course and appropriate decision-making about capital distributions at FERFIs. But the pandemic was not normal course. It was an extraordinary tail risk event which necessitated extraordinary supervisory and regulatory accommodations and protections to complement those accommodations. As the accommodations have receded into the past, so too must the extraordinary protections. And now to our third argument. We have confidence that boards of directors and senior management of FERFIs will act responsibly in making capital distribution decisions. Historically, the boards of directors of Canada's FERFIs and their senior management have, by and large, and with the occasional exception that proves the tendency, made modest, humble, and responsible decisions regarding the strategic direction of their institutions and their capital distributions. We at OSFI expect them to continuously reaffirm this tendency. I would also like to point out that, as superintendent, this expectation is not static, nor does it exist in isolation. A growing number of business executives, entrepreneurs, and investors have expanded their definition of sound business and financial management. Bodies such as the U.S. Business Roundtable, the signatory to the United Nations Principles for Responsible Investment, and to the Glasgow Financial Alliance for Net Zero, have affirmed their commitments to make companies place more intense focus on environmental, social, and governance issues. Coming out of a once-in-a-century pandemic, recognizing that the brunt of the pandemic's costs were borne unevenly across the country, humbled by the notion that their institutions fared quite well through this period, the boards of directors and senior management of Canada's FERFIs will take account, I believe, of their complex environments in making these decisions. They will recognize the special burden and responsibility that flows from their success and from the expanded environmental, social, and governance expectations of their investors. And they will make capital distribution decisions that enhance their institution's reputation and fulfill OSFI's expectations regarding sound risk management. Now, of course, Canadians, including our regulated constituents, the FERFIs and FRPPs, have legitimate expectations of OSFI. You would be quite correct to think that a prudential regulatory authority with oversight over Canada's financial services industry should respond adroitly to the same risks and with the same rigor that we expect of federally regulated financial institutions and pension plans. Just as now is the right time to announce OSFI's lifting of just as now is the right time to announce the lifting of OSFI's expectations regarding capital distributions, it is also the right time to restate our intention of transforming OSFI to meet the opportunities and challenges presented to us by our risk environment. As I stated at the Global Risk Institute on September 29, I believe OSFI must prepare for recurring bouts of volatility and uncertainty, perhaps more frequent than in the first 2 decades of this century. Fervently do I hope this preparation will prove to be unnecessary, but assuredly must we at OSFI adapt to this risk environment. What does this mean for OSFI? It means we'll seek to refine our culture so that it thrives in the face of this growing uncertainty. We will place more emphasis on creating a work culture where it is safe to make mistakes in pursuit of excellence. We will also reinforce our diverse, inclusive work environment and ensure beyond all doubt that at OSFI it is safe to be different and safe to bring your best and true self to work every day. It means we will reposition the pursuit of our mandate to make strengthening public confidence in Canada's financial system the overriding purpose of everything we do at OSFI. And it means developing a wider, more rigorous risk appetite, one fit for tackling climate risk, digitalization, and other risks yet to appear on our horizon. This week, we released a transformational blueprint to OSFI staff that will guide this work. Briefly, we will transform OSFI along 6 dimensions: culture, data, risk management, stakeholder relations, policy innovation, and our supervisory framework. We believe this broad effort will transform OSFI to ensure we thrive in intensifying uncertainty so that the public's confidence in a sound financial system remains unwavering. In summary, I seek the same clarity and responsible decision-making at OSFI that I expect from our regulated constituents. In other words, our expectations of FERPs should be balanced and matched by our own fidelity to those expectations. Whether you are a regulated entity or the regulator, ensuring you have a responsible and forward-thinking organizational culture in place will not just help mitigate the impact of any future black swan events. Rest assured, COVID-19 will not be the last of these. It will also blunt any criticism that due consideration has not been given to acting responsibly and prudently. Echoing what I said earlier in this speech when I announced the removal of our temporary expectations around capital distributions, we expect FERPs to make decisions on other pressing matters addressing climate risk, coping with technology and digitalization, etc., through the same lens. We use the term prudential a lot. In the narrower sense, this means controlling risk and holding adequate capital. But to people outside the financial sector, it carries a broader meaning, using good judgment and reason to ask what could go wrong, or where should I exercise caution. I ask FERPs to carry this broader interpretation with them. I ask our regulated constituents to think the way that their depositors or their policyholders or their creditors think. What level of risk in any decision-making process is acceptable to them, and what would be unacceptable? Am I making decisions based on short-term criteria or planning for the longer term? OSFI's authority only extends to those powers vested in us by Parliament. We cannot prescribe or prohibit investments or loans, etc., beyond what is set out in the statutes governing FERPs. But where our authority allows us to do so, we will work to ensure all FERPs understand and account for all risk exposures, financial and non-financial. So, in conclusion, OSFI is changing how we view risk, and we expect FERPs senior management and boards of directors to change as well. We are working hard both internally and in our external relations towards the goal of ensuring Canada's financial system is protected and respected worldwide, thanks to the prudence exercised by all actors. With my remarks today, I hope I've explained clearly and thoroughly why we made the decisions we made in March 2020, as well as the rationale for why now is the right time for OSFI to lift our expectations of capital distributions. Accordingly, OSFI has just issued a statement indicating that financial institutions may once again increase regular dividends and executive compensation. Additionally, subject to the existing requirement for superintendent approval, they may once again repurchase common shares. I also hope I've impressed upon you all the importance of modest, humble, and responsible decision-making in future decisions around FERPs capital distributions. I think modesty, humility, and responsibility are traits that would serve us well as we plan and evaluate our actions today and tomorrow. Thanks very much for listening. I'll now take a few questions.
And here for the first question, Peter, will this apply to both banks and insurance companies?
Yeah, when we refer to FERFIs or federally regulated financial institutions, we refer to deposit-taking institutions, including banks, federally regulated credit unions, loan and trust companies, etc., and insurers, life insurers, property and casualty insurers, mortgage insurers.
Thank you. Question number 2 is coming in. If you'll bear with me. Un peu de patience, merci. And here with question number 2 for Peter, do you have any views on the housing market?
The housing market and household credit are major areas of focus for OSFI. Obviously, we focus more on household credit because it has a direct impact on bank capital as opposed to the housing market. Let me make a few remarks generally. Since the great financial crisis, 2008 and 9, the housing market has certainly been very healthy and has produced regular increases in valuations in most, if not all, Canadian cities, and certainly on a national basis. It has done so in a fairly benign economic environment, benign up to the onset of the COVID pandemic. Over that decade, we've complemented our we've added protections and prudence, we think, into the distribution of household credit. In that, gradually and in a step-by-step way, we've tightened underwriting conditions for obtaining a mortgage. And sometimes this upsets folks, and other times it gives folks some reason for comfort, because there are far more buffers or protection in the housing system. So for 10 years, we've done quite a bit. We've lowered maximum amortization rates for insured mortgages. We've added a mortgage stress test for both insured and uninsured mortgages, and we've done many other things. As a result, household credit in the main is healthy because it has ample buffers for a downside. However, the vast majority of our regulatory responses to a healthy housing market have been focused on the demand side. Generally speaking, our regulatory measures have tended to add more buffers to the demand for residential mortgage credit. And that's a good thing. It is clear to me and to those of us at OSFI that despite those very prudent measures, the supply of housing is not keeping up with the growth in households. So the supply of housing is not keeping up with household formation. That is adding additional price pressure. And I think over the next 3 to 4 years, Canada and all governments within Canada have an opportunity to bring supply into line with household formation in Canada. And I look forward to having this conversation on housing supply in the years ahead.
Thank you, Peter. Next question is, how will OSFI address emerging ESG risks?
That's a great question. I mentioned in our transformation, one of our dimensions of transformation will be what we call policy innovation. And so the most pressing ESG risk, in my view, is climate, and we will have a major policy innovation effort starting really this month, this year, around climate. you'll see an early output from that effort in the form of a scenario testing study that we conducted with the Bank of Canada and that we will publish at the end of this month. And then going forward, we will begin to engage actively or I should say proactively with Canadians and with our regulated constituents in developing both disclosure and policy responses to the climate change imperative. Beyond climate change, we've actually done a lot of work on what we call non-financial risk, work in and around, for example, operational risk, work in and around the reputation and the culture in organizations, which I think fall under the rubric of ESG. So we've done some work and we will tick it up in the years to come.
Merci. And further to that last question, Peter, can you please share thoughts on how OSFI may ensure climate risk is appropriately factored into the bank's capital allocation decisions?
It's a great question. And the honest and straight answer is we're still working on it. But let me give you some thoughts on where we will be advancing that file over the next year. We need to get much more clarity and structure around disclosure and measurement of climate risk, both physical risk, which is the risk to climate events that may be more severe than they have been in the past as a result of climate change. And two, transition risks, the risks that as the world lowers greenhouse gas emissions, Canada's economy will have an adjustment. And we need to get better disclosure in order to understand what the risks of that adjustment are to Canada's FERFIs. So one way is measurement. The other way, I think, is stress testing. And again, I wouldn't call what we're about to produce at the end of November as a stress test, but it is a scenario test that begins to lay out what the future could look like and what the risks are to Canada's FERFIs as we transition to a lower carbon economy. And I want to assure everyone that although the adjustment is meaningful, it's manageable and there's immense opportunity for Canada. And I think what you'll see in the scenario testing both is risk clearly identified and opportunity clearly identified.
Thank you. Next question. With the EU recently pushing the Basel III capital implementation to 2025, will OSFI make some changes to its Basel III capital implementation?
And so what you're referring to is, I believe, Basel III, the last sort of step of Basel III reforms. We do have a consultation on Basel III updates going on right now, and you can expect to hear more from us in the next year on that. Generally speaking, Canada has established a very good reputation as a financial system that keeps up with and in fact delivers early on the requirements, on the international requirements that flow out of the Basel process. We intend to continue to be near the front of the pack on that.
Thank you, Peter. I think we will have one last question for the time that we have. I will just ask for a little patience until it's shared with me. Merci de votre patience. Here we go. Next question, Peter. Is the lifting of restrictions on capital distribution effective immediately? Any process requirements to be followed other than the normal course ones?
Other than the normal course ones, no, there are no process requirements, additional process requirements, and yes, it is effective.
Thank you. I think this will be the last question. How comfortable are you that the market has accepted the DSB concept? Is the next crisis involving losses, which drives CET1 ratios down, will confidence remain? And I said, if then is the next crisis, I meant if the next crisis involves losses, which drives CET1 ratios down.
Yeah, so it's a very good question in that we did lower the buffer and financial institutions operated through the crisis without severe loan losses, which is a great outcome to have, better that outcome than any other. If the next time we have a downturn or there's another crisis and institutions do have significant loan losses, you might expect that we would be quite vigilant around lowering the buffer. The buffer is meant to be used during hard times and established and sustained during good times. So we will use it during hard times. If and when the next such event occurs on my watch, there's a special burden that falls on my shoulders as superintendent and OSFI's shoulders to communicate in regards to the domestic stability buffer that we mean it, that we expect capital ratios during hard times to fall. And we're comfortable with that because we've built up excess capital buffers during good times. Now we can say that in the moment in peacetime, if I can use that metaphor right now. There's a special burden that will fall on us at OSFI in wartime when we are in a more difficult economic situation, and we'll have to work extra hard to make sure we communicate that message clearly and convincingly.
Thank you, Peter. This concludes today's event. Please note the text of the superintendent's remarks is now available on OSFI's website in French and in English. Merci beaucoup, Peter, and thank you all for attending.
Thanks all. Appreciate the interest.